Want me to make credit score simple? Watch this.
These guys are friends. Let's call them A and B to keep things simple. One night when they're out, B is short on cash and asks A to cover for him. "I promise I'll pay you back," he says. A lends him $20. A week later, B can't find the money to pay him back. "It's okay, it's just a 20, says A. So B feels comfortable in bringing up how he needs $1,000 to pay for his cat's playhouse. "I'll pay you back for that night and this soon, I promise." As we all could have guessed, he doesn't, and a week later, B is offered a job interview, but he must fly out to the company's headquarters to meet the interviewer. He doesn't have money for the flight, so he manages to pay back the $20 super late and forks up $500 for his cat's playhouse. And A reluctantly agrees to pay for B's flight. So what does this show us? The next time B asks for money, A will be less likely to give it to him because of his track record. And you might be thinking that a tracking system to figure out who won't pay money back sounds pretty useful, especially from the perspective of banks and lenders who give out thousands and thousands of loans. And you're right, these institutions rely on a term called credit score.
Welcome to my channel. My name's Pri, and today we're exploring credit score. 30% of Americans have terrible credit, so I'm here to help you find your way to the other 70%. Consider credit score your financial report card. It's used to determine how likely you are to pay back money you borrow. There are tons of reasons that you should aim for a high credit score. If you ever want a house or a car, this will ensure that you actually qualify for the loans associated with these big purchases, but also so you don't get penalized with higher interest rates. Higher interest rates mean that you have to pay more money to the bank for letting you borrow money. Basically, it's their way of earning money off your loan. The higher the risk, the higher the rate. Dude, I have enough to buy a house in cash. I don't need a loan to help me pay it off. Actually, even if you had cash to pay outright, it could make sense to still get a loan. This way, because you pay off your house over an extended period of time, rather than all at once, you will still have money in the bank to use for utilities, investments, and perhaps even more real estate purchases. But we'll talk about leveraging in another video. Additional reasons to aim for a high credit score are if you want to qualify for an exclusive credit card that offers benefits like great cashback, rewards, and even miles that you can use to travel. And lastly, the factors that credit score track, like debt and payment history, can potentially affect if you're hired or not at some jobs. Employers sometimes check a modified version of your credit report as an indicator for financial problems that might indicate risk of theft or fraud. You can see your own credit report. It's a summary of your financial history paying back debts or bills. Although they aren't looking directly at credit score, I wanted to include this one because the factors that indicate good credit are reflected here. I've linked a couple of articles in the description so you can learn more yourself. So who calculates our credit score? Okay, so just like how national testing agencies like SAT or ACT have a specific scoring system that colleges pull to determine students' academic abilities, credit bureaus, also known as credit reporting agencies, allow lenders to pull your credit score to determine your ability to pay back a loan. In the US, the three national credit bureaus are Equifax, Experian, and TransUnion. These guys track most of our credit histories, and each of these agencies use the FICO score algorithm to produce a version of the FICO score based on the data they collect from each consumer. FICO is not the only credit score available, but it is the one you'll hear most about. So in order to achieve the perfect credit score, we need to understand how the FICO scoring algorithm analyzes the information on our credit reports. The credit score's overall purpose is to determine if you'll be over 90 days late on any credit account within the next 24 months. First, payment history has the largest influence on your credit score. It's worth 35% of your overall score. If you already have a history of paying bills late, the odds are you'll make a late payment on a line of credit. The credit bureaus may receive updates about your payment history from credit card issuers and lenders. Amounts owed is the second most influential factor. Worth 30% of your FICO score, the amount of debt you carry, especially credit card debt, is nearly as important as whether or not you pay your bills on time. The primary factor FICO considers in this category is known as credit utilization. Your credit utilization describes how much of your available credit you use each month on revolving credit accounts. For example, if you have a card with $1,000 in credit limit and you spend $200 of those dollars, you would be utilizing 20% of your credit. Aim to maintain the lowest utilization rate you can while still proving that you can pay on time. The golden number is around 10%. Next is the length of credit history, which takes up about 15%. Thankfully, FICO doesn't consider your age when calculating credit score. The age of your accounts, however, is another story. This is because statistically, consumers with longer credit histories are less risky borrowers. The idea is that with more data to work with, the results of the scoring model will be more accurate, which helps a lender be more confident confident in their lending decisions. So what do they actually look at when considering the length of credit history? The average age of your account, how long each account has been open, and the length of time since you've used each account. This is also why you shouldn't close an older credit card, even if you aren't using it. It'll boost the average length of your credit history. Types of credit take up 10%. First is revolving, like a credit card, where you have a certain amount you get to borrow every month. Another is installment, which is periodic payments to pay off a purchase, so like a car or a loan for a house called a mortgage. If you have multiple types of credit, FICO may reward you with a higher credit score. Credit mix is only worth 10%, so it's not as influential, but it's still a great place to grab some extra points. The final 10% of your score comes from new credit. Essentially, if you apply for too much new credit in a short period of time, you might be penalized, even though it's short-term and not permanent. When someone requests a copy of your credit report from a reporting agency, a record of the access is added to your credit report. This record is called a credit inquiry. Hard inquiries take place whenever you apply for something and the lender pulls a copy of your credit report. FICO considers the number of hard inquiries that appear on your credit report within the last 12 months. Too many recent inquiries could be a sign of financial distress, so it looks like you're trying to borrow as much money as possible just to get by. You appear reliant on credit, and thus your score declines. This is super useful to know for when you're about to take out a loan for big purchases. You shouldn't open any new line of credit within a few months of that purchase, or your score may decline temporarily, hurting you with higher interest rates when you try to get that loan. The easiest way to get a high score is opening credit cards the minute you turn 18. Just go to your bank and ask to open a card. Then set your card to automatic payments, in which you're telling your bank to transfer money on a set date for a set amount. This way you don't have to worry about missing payments, and you'll passively build your credit score. You can either do this online or by phone. Even better is when you place subscriptions on your card, you won't even have to worry about purchasing anything. It's like automatic credit score growth. So if this video brought you value, drop a like so the algorithm can push it out to more people. I make content to help people build wealth without all the hype, so subscribe if you're ready to get started. Also, check out my TikTok where I post daily content, and follow my Instagram for more helpful posts. I'll see you guys in the next video.